In the world of real estate, the game is really changing, especially if you're an agent who works with investors. The old skills, yeah, they're still important for sure, but there's this whole new layer of data-driven know-how that's creating a massive gap between the good agents and the truly great ones. Today, we're going to break down the 5 key metrics that really define this new class of agent. So let's get right into what separates the best from the rest.
So, what's the big shift here? Well, at its core, it's pretty simple. For decades, an agent's job was to find the property, get it under contract, and close the deal, right? Mission accomplished. But today's investors, they're looking way past the closing table. The whole conversation has moved from just the transaction itself to the long-term financial performance of that asset. It's not just about buying right anymore. It's about operating right from day one.
So what's driving all this? Honestly, it's a smarter, more sophisticated investor. They're not just glancing at a purchase price and the potential rent anymore. Oh no, they are digging deep. They're asking these really sharp questions about the quality of the income, the stability of the cash flow, and just how durable their investment is going to be. And every single one of those questions, you trace it back, it leads to one master metric.
And that is net operating income, or NOI. This is the ultimate report card for any rental property. It's the pure, clean profit that's left in the bank after every single operational bill gets paid. Every metric we're about to talk about is designed to do one of two things: either push the revenue coming in higher or strategically shrink the expenses going out. And it's all in service of protecting and growing that all-important NOI. Okay, so let's start right where the rubber meets the road. That moment a new lease is signed. The very first hurdle for any investor is turning a vacant unit into a cash-flowing asset and doing it as fast as humanly possible. The modern agent? They know the secret weapon for this is a tool that, honestly, most people have completely misunderstood. And that weapon is tenant screening. For years, we've all thought of screening as like a shield, right? A way to keep bad tenants out and avoid problems down the road. But this new mindset completely flips that script. Good, comprehensive screening isn't just defense, it's offense. It's a tool you can use to actively accelerate your cash flow by finding and onboarding great tenants who are ready to go faster.
And the numbers? They're pretty staggering. I mean, check this out. According to data from RentRedi, when landlords use a full 5-point screening process, we're talking background check, credit, criminal, eviction history, the whole deal, their new tenants send in that all-important first rent payment an average of 17 days faster. Think about that. That's over 2 weeks of lost rent just gone, wiped right off the books.
And the payoff just keeps going, long after they've moved in. Those same screen tenants, they end up paying on time 90% of the time. That's a full 7-point jump over unscreened tenants. The takeaway here is crystal clear. Doing better screening at the very beginning creates a much more predictable, more profitable income stream for the entire life of that lease. Okay, so getting paid fast is the first big win. But for serious investors, consistency is everything, which brings us to our next level of expertise: actually engineering stability into the cash flow. This is about making sure that income isn't just something you hope for every month, but it's a predictable, reliable reality.
Look, we all get excited about seeing big rent growth in a hot market. But reliability? That's where true performance is really measured. A huge rent number on paper is totally useless if you're struggling to actually collect it. The best agents are now using national benchmarks to add context, to show an investor not just what they're collecting, but how well that collection performance stacks up against the rest of the market. Now that is a conversation that builds some serious credibility.
And one of the most powerful ways to engineer this reliability is through simple, smart systems. Just look at the impact of autopay. Tenants who are enrolled in autopay pay on time at an almost perfect 99% rate. Now compare that to 87% for those who aren't. That 12-point gap isn't just about convenience, it's a fundamental structural improvement to the investment that smooths out income and gets rid of all that friction.
And even tiny little nudges in communication can have these huge results. For tenants who miss their due date, a simple automated reminder can literally be the difference between getting paid this week or next month. 58% of tenants who get a reminder pay up within the grace period. Only 38% of those who don't get one do. It's such a low-effort, high-impact strategy to lock in that cash flow. Okay, we've talked a lot about the income side of the equation. But remember, NOI has 2 levers, right? So now we're going to pivot over to expenses. A truly modern agent understands that mastering operational efficiency is just as critical to an investor's bottom line as pushing rents.
And the key metric to watch here is the operating expense ratio, or OER. This simple formula tells you exactly how many cents of every single dollar of income are being eaten up by expenses. Think of it like an X-ray for the property. It lets you look beneath the surface of the financials to see just how lean and mean the operation really is.
And this points to a really profound insight for any agent who's looking for an edge. You see, a property with sky-high rents might look great on the surface, but it could be totally maxed out. On the other hand, a property with a high OER, a bloated expense line, is basically screaming that there's hidden value just waiting to be unlocked. And being the agent who can spot that potential upside, that's how you become absolutely indispensable.
So let's bring this all together with our final set of metrics. This is all about playing the long game. It's about understanding those subtle forces, like churn and retention, that can either silently drain an investment's profitability over time or powerfully compound it.
This means you have to look at move-outs not as just these isolated events, but as a really rich source of data. The sharpest advisors out there, they're tracking not just the vacancy rate, but the average number of days a unit sits empty. They're analyzing how often turnover happens, and this is crucial, the true all-in cost of every single turn, from the paint and repairs to the marketing and, of course, the lost rent.
So what this really all means is that tenant retention gets a total rebrand. It stops being this kind of fuzzy, nice-to-have operational goal, and it becomes what it actually is, a measurable, high-impact driver of NOI. When you really dig in and analyze why residents stay or why they leave, you get these powerful insights that help you plan smarter capital improvements and leasing strategies, all of it aimed at cutting down the very high cost of churn.
So there you have it. It's the modern agent's playbook. Step 1. Accelerate that initial income by using screening as an offensive weapon. Step 2. Engineer cash flow stability with smart, simple systems. Step 3. Uncover that hidden value by mastering the OER. And Step 4. Sustain that long-term performance by turning turnover data into a real strategic advantage. Now let's be crystal clear about something. This doesn't replace the core skills of pricing, running comps, and market analysis. Not at all. It supercharges them. It adds this powerful, undeniable layer of operational data that proves the property's income isn't just attractive on paper, it's durable and it's defensible. This is the new language of trust and expertise for investor clients.
And all of this really just leaves us with one final challenging question for every agent listening right now. Are you advising on the deal that's right in front of you? Or are you truly equipped to advise on the performance of the entire investment long after closing day? Because in today's market, that is the difference that matters most. Thanks for tuning in.